And really what's interesting about this is there have been a lot of up years in the market, as we know, 25, 30%. But up years with this kind of little complacency and variance is what's so unusual. And the presumption is it will not continue. So if you were to look at the average daily move in the S&P this year, you're talking about 50 basis points per day. And that is a very, very low percentage. Typically, markets move almost 1% a day. So these peaks that you see here, this is the 73, 74 bear market. This is the 87 crash. This is the September 11th event. And this, of course, is the Great Recession. But what happens is after plunges like this, in terms of the day-to-day variance, you get ricochets. And so whether you're bearish or bullish, the presumption is that the buy and hold strategy, which is the number one strategy this year, is not going to be the number one strategy in 2014. So that the conclusion is day-to-day variance in the market will be much greater than 50 basis points per day.
So it'll be a stock picker's market in 2014
exactly right.
as opposed to riding the indices overall.
So it's the spread between a major asset class, equities, and commodities. You know, the commodities spike well above equities, and now we have this equally impressive spike in terms of equities above commodities. And the presumption is that this cannot last. Here's the tell. The most important commodity of all, copper, has all the hallmarks of an important head and shoulders bottom. Here's the neckline. This looks like this is going meaningfully higher. And what that suggests is that commodities actually outperform equities in 2014.
Which would be fantastic. And
for you and your FCX.
And Timmy talked about it as well. So if Charter Worth is correct, and he typically is, I mean, the Freeport-McMoRan we mentioned and the names that Timmy mentioned should actually do well in 2014.
The important thing, I think what he's saying is underlying commodities are, copper's holding, but the companies themselves with the operating leverage they have into this environment are going to absolutely outperform the underlying commodities, and that's where you want to be.
Hey, Carter, I'm just wondering, does that imply also that stocks will decline?
Well, it's one of two things. Stocks can be quite fallow after a big year like this as commodities start to move higher. And we're seeing it, as Tim said, in certain steel stocks and so forth. They're acting quite well. The suggestion is this will be fixed. It's too extreme.
All right, Carter, chart number one.
Sure, and happily it has nothing to do with me. It's just one of the great facts of markets, and here's what it is. If the market is up in the first 5 days of the year, this is something known as the January barometer. January for the month is up 76% of the time. That's going back to 1928. And then it ensues that, of course, if the first 5 days are up, if January itself is up for the month, the year is up 82% of the time. So we're going on vacation tomorrow, and when we come back, those first few days determine so much of the probabilities of the year. Here is a chart of the last year that we just ended now. This is the month of January. As we know, it was up 5.5%, and of course, with tonight's close, we closed the year up 30%. As January goes, so goes the market. As the first 5 days of January goes, so goes January.